Hey everyone, this is the Trader Investor. Let's discuss the markets today. How did they act? How did they close? Were they moving in the direction that we anticipated? A lot of that, of the things that I mentioned this morning, I want to go over that. And so let's start with the SPYs. In the SPYs, and you could have applied the same principle across the board, but I'll just use the SPYs as a good example. I went and drew a Fibonacci retracement from the close of yesterday to the open of today. And what I used is just the regular market hours. I didn't use the extended hours. That, for me, that just skews the data. It just doesn't work the way I want it to work. That's why I eliminate extended data. If I want to see extended data, I will look at the ES. That will give me the full range of the extended data. That's what I will look at. So I just focus on just the regular trading hours, the cash market hours open. So from the close of yesterday to the open of today. And what I wanted to use that for is to validate where my potential areas of reversals are, where price could go to, where does it want to turn. All of those things I will look at in the 15 minutes. So a couple of things. The first one is I mentioned that if price breaks the 15-minute range, it is likely going to stop either at the negative 27.8% retracement, or it will want to go to the negative 61.8 retracement. And the only way we know it is going to go past that 27.8 retracement is a close below it, a reversal to test it, and continue its way down, because we have an imbalance at the bottom to take care of. So because of that, there was no rush, absolutely zero rush to enter a position, a put position at the break of the 15-minute range. No trade the first 15 minutes, right? So after that, there was absolutely zero rush to enter that trade. So what happens? Multiple times. It tried, failed. It tried, failed. It tried, failed. So anybody who had tried to go short put position was manipulated 3 different times. First time here, price reverses. Another time here, price reverses. Another time here, price reverses. Anybody who has gone long at the touch and rejection here, if they didn't have a wide enough stop, they were also manipulated. But I believe today's manipulation was more focused on the shorts. Why? Because we have a big gap down day. Because we have this big gap, there's a tendency for psychologically for people, especially retailers, to say, well, there's this big gap. I missed this huge move from 412 area, from 11 and 80 to about 407.30. So it's $4 move. I missed this $4 move. I better chase. And you get trapped. So I think that's where the market makers, the smart money, they knew that there were some retailers hungry for that move to continue and close this imbalance, go to the low of last week, Wednesday. This is some of the areas they were looking at. Look at the confluence. The low of last week is the same as the negative 61.8% retracement. So because of that, there was no put entry. There were a couple if you were aggressive, and I will talk about those in just a minute. But then the other thing that I mentioned is, here's an imbalance. We're going to close this imbalance. But before you jump in, a couple of things to take care of. And were you careful enough and took advantage of these areas of trigger that were beautiful, beautiful today? So the break of the 15 minutes, first time it broke, you have a headwind, the mid-range of last week Thursday. That's your headwind. Because it's not too far away, right? This was not 2 weeks, 3 weeks ago. This was less than a week ago. So what do I want to see when that happens? I want to see a break of that 15-minute range, whether it's high, mid, or low. Price pulls back, rallies depending on which side we play, and breaks it the second time. At the second time, you're golden. So entry number 1. This was a beautiful entry to go get call positions, because at the second time you enter from 408, 10, 15 area, it gave you 4, 10, 15, $2 move. Beautiful, beautiful move with no pain in this movement. And if you are one of those traders that take half of your position at some predetermined gain, and your second half you only have it at maybe break even, maybe slightly below break even, you might have even been able to stay in this trade towards the end of the day to capture the whole move. But that's not how I trade. Once I have my target 1, my target 2, my target 3 has very tight stop, and 2 bars closing below the third bar to the left, there's no way I'm going to hold that position, because I don't know if that's a turning point. So that's one way to look at it. But you had a beautiful entry here. So let me talk about aggressive entries twice. 11 a.m. Pacific time, 2 p.m. Eastern time, FOMC minutes. Because of that, I knew there was going to be movement to the upside or to the downside. I didn't know which way. So when price pulls back, is this a possible area of long position, right? A continuation of this move, or is it a reversal? So we look for a reversal when we fail to make a high. So we have a high, we fail to make that high. So at the break of the pin bar, right, even though the second bar went above the pin bar, but we have failed to make a new high, at the low of that pin bar is our entry for a short position, a dollar move. That's all we want to see. So 409 to the high of the 15-minute range, 407.61, $1.40, plus the VWAP again is not in the way, right? If the VWAP is between price and the high of the 15-minute range, I want to see $1 to that VWAP. In this instance, it was far away, more than $1 distance. Boom, beautiful put position. Take 10 contracts very, very comfortably, because as soon as price goes above the recent highs, you're going to exit if you didn't have the right setup, right? If the setup is good, it gave you a signal. It gave you a signal to do this, and this was your target. But then instead of this, if it just moves slightly and reverses, you're out here. So you're okay to take those signals. One, you've captured good moves here. You're not giving back a lot of that back here, and you have positioned yourself to take advantage of the situation. That's first opportunity on the put side. I say first opportunity because if you are a little bit more aggressive, there was another opportunity when the 15-minute failed to make a high, and you can target the negative 27.8% retracement. Again, this was more than $1, but this is a little bit more aggressive. Twice you had that opportunity, very aggressive, but I think this one was the best one to take for less aggressive entry. A second time that this gave you, it gave you a pullback. It made a high, right? It terminated that, it made a high, but then the next bar failed to make another high. So it gave you an equal high. It gave you an equal high area of liquidity. Then you could have decided that you want to take another position to the downside. Where do you enter? At about halfway of this bar. So if this bar keeps making a halfway entry, is there enough distance between that and VWAP, or that and the high of the 15-minute range, 409.30 area, somewhere around there, to 407.60, more than $1 move, right? $1.70 or so, you're happy to take this trade. So one opportunity here, one opportunity here. And for me, it was towards the end of the day. I've already captured these gains. I've already made it once. I did not have the time to monitor this trade. Therefore, I did not take this position. But this was a very, very valid entry. 1, 2, 3. So 3 positions. There are 2 more opportunities to go on the call side, right? 2 on the put side, 1 on the call side. The other position is when price tests the high of the 15-minute range first time, because we've already had a lower high, right? So because we've had a lower high, we're not going to rush and say, oh, it tested it, I'm entering. No, we have a lower high. We want to see if it will give us another opportunity to test it again, which it did. It tested it again. Now we're comfortable and say, okay, at the break of this bar, I'm entering. Boom. It gave you then from 409 to 410.96 and almost $2. So you have this one opportunity. The other one is the last 15 minutes. I don't like to enter new trades the last 15 minutes. But once you have a new trend, right? Uptrend, downtrend, uptrend. In that uptrend, when you have a short pullback, testing the some area of value, which is in something like a retracement area, then you can enter again long. But I don't usually enter those last minute positions. But look at this. This was a $2.38 move bar, just one bar. So if you had ventured and say, hey, this was a short pullback, I'm entering, and I can remove this retracement for you. Oh, before I do, just one more thing I will mention. Look where this retracement terminated, at the 61.8 retracement. It never went above the 78.6% retracement. It went as high as 70, but didn't even close above it. So this is why I was comfortable twice here and both here. That's why I say it's valid, because it never closed above 70%. It never closed above 78% retracement. So that's why I'm going to remove it now. And for this entry, how do you get comfortable? Well, from the low to the high during that pullback, does price penetrate below 70% or below the 78.6% retracement? No, the answer is no. It stopped dead at the 61.8 retracement. And as soon as price reverses about halfway through this bar, you can enter targeting $1, because it's end of the day. Just target $1, take your whole exit, and you're done, because it's the last 15 minutes. I don't want to swing. Why don't I want to swing? We talked about this multiple times. Even yesterday I mentioned, or this morning I mentioned, why I don't like to swing. Look, this big gap down. It was unexpected big gap down. That's why I don't like to swing. So a few things to mention that are important. Price, the 15-minute range of Thursday, price stalled there once, reverses. The high, price stalled there one, reverses. But how do you know that this reversal is good? Is because the area where it stalls, we can remove this. The area where it stalls, the pullback is not deep. Very shallow pullback and immediately reverses. Here, it's not even a pullback below the bar that tested it. It's a, up, down, up, down, up, and boom, it's gone. Once it's gone, it's clear. It's cleared the way from that 15-minute range, the high of that 15-minute range. This is 409.10 to 410.05. It gave you actually that dollar move. Now you should have been in a position somewhere down here and not have to re-enter. I just give you this signal because when price stalls here and doesn't go below the bar that tests it, or it stalls here and you don't enter, you wait and you enter at the next bar, no pain, no pain. It stalls here but it doesn't reverse, so you're comfortable to stay in the trade. You continue your upward movement until you see, well, these two bearish bars, not a good sign, you exit. So beautiful day today. We close the imbalance. As soon as we go halfway through the imbalance, we are done. That imbalance is taken care of, so I can remove it. And now we just wait and see where the markets open tomorrow for our entry. I've talked a lot about the SPYs, but it's a similar story across the board. Thursday's 15-minute range acted as resistance. Price broke through that, reverses for a short while, breaks through it again. The mid, same thing, gets there, rejected, but shortly. That again gets to the high, rejected. These are all my headwinds, right? My next headwind is Tuesday's 15-minute range, Wednesday or Monday's 15-minute range, Friday's 15-minute range. These are all my headwinds. Where did price finally go to? Friday's 15-minute range. It hits it and it reverses. And now trying to hit it again, the day ended. So these are very important levels. I want you to keep watching these levels. Price will go stall. Now, if you were, at the 15-minute range low of Thursday and price gave you a big bar down, that's when you say, well, this is the end of that road. But that didn't happen. You continue. When it gets here, it could be the end of the road. This one is a little tricky because it's a big bar down, but this big bar down was smaller than the previous bar. So if you're comfortable, you stay in the trade. If not, you exit. There is nothing wrong with protecting your assets, protecting your capital, and protecting your gains. There's nothing wrong with that. So if this is too big of a bar to take a risk, take an exit. It's a beautiful exit. So all of them today, they acted really well towards our signals. The 15-minute range of Friday was the headwind for today for IWM. Why? Because it aligned with our 15-minute range high today. So price really struggled to go through it. Really struggled. Once it go through it, it reversed, and you could have taken a chance and an entry, but you were stopped out. Here's why you don't take an entry here. Nothing to do with technical analysis. This one is purely fundamental. The setup was beautiful. The setup was perfect. There was nothing wrong with the setup. Area was manipulated. Price gave you a false break. Reversed. However, FOMC minutes. Because you know that you do not enter a position. You don't enter ahead of it. You can, once the news comes out and price shows you direction, like in the SPYs, price said, I am going to show you that I don't want to make a new high. I'm making a lower high and I'm going to go down. Then you can enter a position. Quick in and out. This was a 15 minutes in and out position. But in IWM, the signal came 15 minutes ahead. Do you enter that signal? Absolutely not, because in 15 minutes you have the FOMC minutes. So that's why you don't enter this setup. That's why this zone was not a tradable zone. After that is completed, it was very choppy. IWM was not clean, so there was no real entry. But overall, it was an update. Diamonds, similar story. But diamonds, we had an order block down here, and we immediately closed that order block within an hour of opening, right? Within an hour of opening, we closed that imbalance. Not an order block, sorry, imbalance. So once this imbalance was taken care of and price started to reverse, we stayed above VWAP, you had some entries. At 11, you failed to make a new high, beautiful entry. Now did the diamonds give you enough distance for an entry? Here's where I get concerned. At the break of this pin bar, when I failed to make a high here, at the I don't take a trade here because FOMC is coming in 15 minutes. In 15 minutes, when I fail to make a new high and I break the pin bar, that's my entry. Do I enter? Not in the diamonds. Why? Because the distance between my entry and the 15-minute range high is cents, right? It's maybe 20 cents, maybe 30 cents maximum. I am not entering that position at all. So this is why the diamonds were not a good entry for us. Now, towards the end, at 1 hour before market closed, you saw price kept testing the mid, didn't close below the mid, and once you break the high of the previous bar, or if you go halfway through a big bar, you can enter 338 to a high of 339, and it even went higher. So you could have entered those positions. But today, the most beautiful was SPY. VWAP above mid-range, price way above the 15-minute range. Just beautiful setup, and you had multiple opportunities. Did you take advantage of them? If not, why not? What is missing? What is preventing you from pulling the trigger? Can I help you see the charts in a better way? Just leave me a comment below and we can discuss that. All right, everyone, take care, and I will see you in the morning.